Have you ever heard of a reverse bank robbery before? You know, where the bank actually robs you when you put your money in? Before you think I'm joking, I'm not. This actually happened to a lot of people this past summer, and it's only just now being revealed how much money was actually robbed from people. Turns out over 100 million, about $109 million across 8 banks were robbed from their customers. And so far, people are only seeing pennies of this money back that was all supposedly FDIC insured. So I wanted to cover this because I think it's a very crazy thing that happened to people, and kind of want to give people some tips on how you can avoid this happening to you. But first, let's go over some of the stories of people and how much money they actually had in these banks and which banks they were. So if anybody's ever heard of the bank Yata, it's not really a bank, but it was advertised as a bank. And it was basically this savings platform where you deposit money, and they advertised it, made it look and work like a bank and feel like a bank, when in fact it's not a bank. It's a fintech company where they take the money and it's managed by another company, which was called Synapse, and they were the ones who were responsible for basically making deposits on behalf of Yata customers to different banks that are FDIC insured. But what happened is Synapse, who manages all of those deposits, that company failed, and now they are completely out of business, and everybody's left pointing fingers and playing the blame game of who's responsible for this $109 million of customers' money. Just this one couple alone, they sold their house, okay? And they tucked away $282,000 in this bank. So first of all, big red flag mistake on their behalf, because they're beyond the FDIC limit of $250,000. That's the first mistake that this couple made. You shouldn't do that regardless of how reputable the bank is, because if there were to be a failure, then you'd be losing out on that extra $32,000 in the event that the bank collapses, and you do need to get that FDIC insurance claim. They decided to stick the money with Yata because there was promises of higher returns than normal banks. And that was pretty much their selling point. They have been locked out of their bank account for the past 6 months as of November. This couple, they have hope that they're one day gonna get their money back, but for now, they're stuck wondering when and how much. But they recently got a letter from Evolve, who is the bank that supposedly has their money, okay? And they said they were only gonna get $500 back of the 280 grand. Can you imagine like the heart-sinking feeling that they must have felt getting this letter? I mean, $500, you might as well kick me in the nuts. You know what I mean? That's what it is. It's a kick in the nuts, or similar parts if you don't have nuts. So all this happened when Synapse, who is the fintech company that was in charge of managing everyone's deposits, right, and making sure it's going into different banks and earning interest and all of that, they had a dispute with Evolve Bank, which was the biggest bank involved with this. They ended up turning off access to a key system used to process transactions. And then shortly after that, Synapse filed for bankruptcy, and they found out they were missing over $100 million of clients' money. And now fast forward 6 months later, nobody knows where the money is, which sounds like a giant scam to me, guys. I feel like they probably do know where the money is. Maybe a lot of it was stolen, who knows? This really reeks of an FTX-like situation. That's just an accusation on my behalf. I have no idea if that's actually the case or not, but it definitely feels a lot like that. And what happened to a lot of these depositors is they believed whenever they put the money into Yata savings that they were actually covered by the FDIC, and it's turning out to be that that is not the case, because the problem is there's a middleman, right? Yata wasn't a real bank. It never was. But people get kind of fooled into thinking that it is, and they get kind of distracted by the fact that, wow, they're offering some fantastic returns, we should take advantage of this, without looking into the full details of how their deposit may or may not be protected. And Yata is actually just one piece of this. There's actually another bank called Juno Bank that Synapse was responsible for their deposits, and they're having similar issues. But just from Yata alone, Yata customers had about $65 million in deposits. Right now, they're only being offered 11.8 million back in that money being returned. So you're getting these huge kicks in the nuts from these banks, and basically there's no recourse for the customers just yet. They say that people are owed money anywhere between $7,000 and $200,000, guys. This is absolutely devastating for the people that had money in there. They talked to another guy who had almost $95,000 in there, and now he just found out that he's only going to get $128 back. Once again, another huge kick in the nuts. And right now, the big question is who's really to blame for this? Because Synapse, who's the middleman, who's in charge of managing everybody's money, they are blaming Evolve Bank, and they're saying that Evolve Bank is withholding customer funds, and Evolve Bank is pushing back on Synapse and saying, no, that's not how it's going. In fact, what happened is Synapse mismanaged user funds. Now, just on the surface, when I think about this, and I'm not taking sides here, and you look at what happened with FTX, this definitely seems like it was probably more the fault of Synapse rather than Evolve Bank. Because think about it, Evolve Bank is a real bank that is FDIC insured, okay? However, Synapse is not. And they gave money to Yata, who then gave it to Synapse to manage and deposit into all of these banks. And if Synapse didn't do the right thing with the money, and that money somehow went missing, and now all of a sudden Synapse is the company that filed for bankruptcy, who looks more guilty here? Now, I'm not saying for sure it's Synapse's fault. I don't know. But based on the evidence at hand, it looks like they are far more likely to be guilty than Evolve Bank. That's just my opinion. You know, I have a good rotation for my neighborhoods. I only walk the same streets like maybe once every 2 or 3 months. Even though I do the same neighborhoods, I do different streets, right? But I remember seeing this house when it first came up for sale 1 year ago now, in November of 2023, okay? The original listing price was $1.95 million. And then in May, they ended up taking this house off the market, and then they relisted it again for $1.725 million in September, guys. Like, the market just isn't moving here. And I guarantee you, the extremely high carrying costs of these homes is the reason. Not only is the house extremely expensive, but so are the property taxes and insurance. In fact, I had insurance quoted for this neighborhood when I did an insurance video last year, and people are gonna be paying easily $20,000, $30,000 a year to insure homes like this. And that's just one expense. Here's the reason that these deposits are not covered, guys. You're asking, like, why are these deposits not covered if Evolve is a real bank and deposits are FDIC insured? I'm glad you asked. It's because Evolve is still in business. Evolve didn't file for bankruptcy. Evolve is going strong as a bank. And the only time the FDIC insures any lost deposits is when there's a bank failure, just like we saw with Silicon Valley Bank. They stepped in and they covered above and beyond what they needed to. They covered FDIC insured losses and far above and beyond that, which was criminal, but they did it. But in this case, there has been no bank failure. Evolve is still in business, so there's nothing for the FDIC to intervene for. The mistake that the people made that gave this money to Yata, who then gave it to Synapse, who then gave it to multiple different banks, Evolve just being one of them, the mistake that people made is they let somebody else handle their money, okay? They gave it to this company, Yata, and Yata trusted another company who ended up going bankrupt. That's why everybody is in big trouble with this and may not actually see this money come back to them. And of course, there's no real checks and balances on this kind of thing. People are somehow able to get away with this still in 2024. How there's no laws on the books preventing stuff like this, I have no idea. So actually in September of this year, Yata ended up suing Evolve Bank. They accused the bank of conspiring with Synapse to take Yata's customer funds. So if that's what Yata thinks happened, and they obviously are much more involved in this than I am, maybe that's what happened. Maybe these guys actually did work in tandem, in cahoots, to make it look like it's Synapse's fault, but they're bankrupt, so nothing can be done on their end. And because Evolve Bank is still running strong and there's no bank failure, then there's no FDIC claims or payouts necessary by law. So it's kind of like the perfect scam if that's what they indeed did. So far, the law has done nothing about this. The FDIC doesn't cover failures of non-banks, companies like Synapse. It's not a bank, so it's not covered under insurance. Supposedly, the Federal Reserve says that they're going to be keeping an eye on Evolve to make sure that people get all their money back. What kind of power they have over this situation? Probably not much. All they have to do is make sure that the bank is complying with the law, but they are, right? That's the genius of this scam, because there was no bank failure, so they're not doing anything illegal, right? In September, the FDIC actually proposed a new rule that would force banks to keep detailed records for customers of fintech apps, which improves the chances that they qualify for coverage in a future calamity and cutting the risk that the funds would go missing. Evolve is saying that the vast majority of the funds that were held on behalf of Yata and other customers were moved to other banks in October and November of 2023 by direction of Synapse. And they said once the money left their bank, they have no idea what happened to it. That's not Evolve's business, that's the business of Synapse, who is now bankrupt. So the big question is, how can you prevent something like this from happening to you? Okay, well, there's a couple things you can do. The first thing is, you should never trust another company with your money, guys. Like, if you really want to prevent it, that's the first thing you can do. The next thing you can do is to guarantee or find out that your bank is FDIC insured. And here's how to do that directly from the FDIC. You can ask the bank representative, but that only works obviously for physical branches, and there's a lot of online banks today, but you can still call them and do that. You can also call the FDIC at this number here, and you can use the FDIC's bank find tool, which you can also just type in there and find your bank to see if it is covered or not. So that's how you find out if a bank is FDIC insured. But there's also kind of a gray area with banks, especially online banks. And this is a question that one of my viewers, Victoria, she wrote to me, and it kind of inspired me to make this video a little bit. And what she was asking about is because a month or so ago, I had in a video about the different banks that still have good, high-paying, high-yield savings accounts, that are closer at 5% still. And she's like, well, how do I know that these banks are legit? How do I know that they're FDIC insured? It could just be some fake scam bank, just kind of like this, right? Well, this is how you find out. You use these tools I just mentioned here, first of all. But the gray area and the middle area with this are banks that are like kind of secondary banks, like subsidiaries. Think of how you have the cell phone companies like Verizon and AT&T and T-Mobile, right? But underneath those companies are a bunch of resellers, right? They resell cell phone services under brands like Cricket, Invisible, or Metro PCS. So then you have banks like this, for example, Brio Direct, okay? And the reason I'm bringing this one up is because I actually have an account with these people, okay? But when you look at all of this, you see when you open up a high yield savings account, which is at 4.85% right now with Brio Direct, it says here that you get your peace of mind knowing your money is safe and secure because Brio Direct is powered by Webster Bank, which is an FDIC insured institution. When you open your account online, it is provided by Webster Bank, and you will be a client of Webster Bank, an institution you can count on and here to help you achieve your savings goals today and tomorrow. So is this safe? The answer is yes. Why is it safe? Because it's telling you directly that you are going to be a customer of Webster Bank, who is an FDIC insured bank. You're not giving your money to a company like Yata, who is not a bank, who is also not FDIC insured, promising that they're going to deposit the money into an FDIC insured bank. That's the huge difference here that people need to understand. And if you look at the fine print with Brio Direct, they also say here at the bottom of their website that all deposit products are provided by Webster Bank, an FDIC insured institution. And Brio Direct is just a sub-brand of Webster Bank. Brio Bank is just a trade name that they operate under. All the accounts open through BrioDirectBanking.com are marketed by Brio Direct and are Webster Bank accounts. Deposits in these accounts are made with Webster Bank. So this is how you know this is legit. When you're going to open a new account, this mainly applies to online savings accounts, guys. You really don't have to worry about this when you're opening an account at one of the big banks that still have physical branches for the most part. But if it's a local bank that you've never heard of, it is worth using this FDIC finder tool to make sure that they are a legitimate bank. And if you don't do this type of research and don't do this type of due diligence when you're handing over a lot of money to a company you're unsure about and you end up losing it, it's your fault, guys. In the end, it's your fault because it's your money, so it's your responsibility to be the custodian of that money. You don't just hand it over to some company in promise of high returns, okay? Especially if it's not a real bank. So I hope it made it clear on how to figure this out. It's really not that difficult, but it does require a little upfront research before you make any deposits with anyone. Now, switching to an entirely different subject, as I usually do here in the videos, right now, there's a lot of tension over the return to office mandates that are supposedly coming in 2025. And the thing is, you have to wonder, how delusional are these companies and CEOs that are wanting their workers to come back to the office full time? You know, because so many people have gotten used to it, and so many people have said, you know what, if I get called back in, I will just quit. You know, I'll find somewhere else where I can work remotely, and a lot of people are doing that. So what kind of leverage are these employers going to have over people to actually get them back? There was a recent survey by KPMG that said about 8 in 10 CEOs envision a full return to the office in the next 3 years versus 34% who had this prediction just a year earlier. And 86% of CEOs said that they will reward employees who make an effort to come into the office with favorable assignments, raises, or promotions. So that is the leverage that they plan on using, basically favoritism and giving people who decide to come in a much bigger upper hand at the company. 80% of remote workers say that the flexible work arrangement is crucial to them, and more than half of them say they'd be willing to turn down a salary increase for more freedom over when and where they can do their job. So people are starting to care more about that than the actual amount of money, which is kind of surprising considering so many people are broke. But it also does reveal a little bit of human nature here, in the sense that people do value things other than money. They do put other things in their life as a priority more than money. And this is a perfect example of that. People have now realized, now that they've had this freedom for a little while, that, hey, I value this freedom more than the money. If that's the case and you're being bullied by your employer, so you should find somewhere else to work or consider starting your own business. That's the only way you're going to keep that freedom. In fact, the return to the office mandates is something that Elon Musk and Vivek Ramaswamy, they plan on using this for federal government workers that are working remotely right now, as basically a way to get a lot of them to quit, because they know that workers feel like this and they do value that freedom, and they would rather quit than go back to the office. And that's a way to cut government waste and government spending. Welcome to Price Cut City over here. This house was purchased back in May of 2022 for $3.45 million, listed for rent for $24,000 a month just a month later. Then they ended up cutting the rent all the way down to $14,000 a month. Apparently never got it rented, took it off the market, then listed it back for sale in September this year for $3.85 million. And then they just recently did a $200,000 price cut. Now they're down to $3.65, guys, only $200,000 more than they paid for this house. So at that rate, by the time you sell it, by the time you pay commissions, by the time you pay closing costs and everything, even if they were able to sell for $3.65 million, they would be essentially just breaking even on this house. And obviously they're probably not going to be able to sell it for that, because they've already cut the price substantially. People can see what it was purchased for just 2 years ago. They basically paid $3.5 million for this house. People see what's happening with the market here. Things are going down. The insurance rates are insane. Property taxes are insane. People want a deal. But apparently companies do have another downside to requiring workers to come into the office, and that is the turnover rate. So apparently the traditional in-person work turnover rate is around 30%, which is double the typical company that offers remote work or hybrid work positions. So people are just much more satisfied with the idea of hybrid work or full-time remote work. And apparently they're willing to sacrifice money, they're willing to sacrifice finding a new job and instability in order to get this set up. And I don't blame them, guys, I really don't. I mean, we also need to acknowledge that some companies just can't operate efficiently without people coming into the office. But, you know, these companies shouldn't have made these promises either, that these positions are going to go remote and stay remote, and now they all are kind of like going back on that promise and requiring everybody to come back in. You should have never made this remote work policy to begin with if you weren't planning on sticking with it. In the last year, just baby boomers alone, okay? The amount of them that say that flexible work arrangement is more important than a salary increase went from 29% to 38%. Gen Xers went from 49% to 54%. Millennials, 67% to 71%. Gen Z, they're still the same at 76%. So you can see so many people, even on the older side of the spectrum now, are valuing remote work more than a salary increase. And apparently women are more likely to say that the ability to work from home and the flexibility are a must-have benefit compared to men, which makes a lot of sense since women are typically more involved in childcare. But apparently there's been a 10% uptick in jobs that pay 6 figures a year that are remote positions, and a lot of these companies are mid-sized employers who are realizing remote options are the key to attracting and retaining the top-tier talent and staying competitive, while the larger employers continue with their return to the office mandates. So they're kind of like poaching a lot of that talent for people that don't want to return to the office. So we'll see how all this goes, guys, but mainly I want everybody to remember that if you are going to give any bank any of your money, you need to verify that, number one, it's a real bank you're giving your money to. It's okay if it's a subsidiary like Rio Direct, like we covered in this video, but if it's not a subsidiary and it's like a company that says we are not a bank and we are promising this return, walk away. That's my advice. You can do whatever you want, but I wouldn't give a company like that $1 of my money. I want everything I have to be completely FDIC insured if I'm going to deposit money in a bank. So if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.